founder or an entrepreneur. If you want to take your company value to 300 million, we gon' show you how to do it. But we got the roadmap, the aspirations. We'll give you a game plan and strategies. Seize control of your company's destiny today by tuning in to Private Capital Mastery. Yeah. Let's start the show.
Welcome back to the Private Capital Mastery Podcast and community. I'm Brian Franco, and thank you for joining us. Today's title is Buyouts, Independent Sponsors and Funding. And with me today is Bruce Lipian from Stone Creek Capital, and he's going to be demystifying the mysteries. So, Bruce, thank you for being here and spending the time with us. How you doing?
Terrific.
Wonderful. So tell us a little bit about yourself and your firm and you know how you spend your entire life on Earth. How did you end up here?
It was not a linear path.
Okay.
After graduate school, I went into banking, and I was a lender for 5 years. And I chose that path, by the way, because I wanted to learn about the viability of a business. And the great thing about being a lender is you learn that if a company isn't able to generate cash flow, it's going to be a bad loan.
Yeah.
And so that really opened up my eyes in terms of understanding how companies work, as well as exposure to a lot of different businesses. In '88, I was lucky enough to be recruited to a private equity group named Kelso, and one of the pioneers of private equity.
Wow.
And in '92, myself and two of the Kelso partners went off on our own, and we formed what was called the Gordon plus Morris Group. So Lipian was in really small print. I was a junior partner. And in '95, we raised a $60 million fund.
Wow.
And over the course of the next 5 years, we invested that capital. But during that period, myself and the other junior partner, his name's Drew Adams, and we're partners. We've been partners for over 30 years. We went to Mike Gordon, John Morris, said, guys, could we have more authority in terms of investing the fund? And they were kind of backing away. So we actually changed the name to Stone Creek for the simple reason that I didn't want people asking, how'd I get stuck with Lipian? Why can't I have Gordon? Or why can't I have Morris?
Yes.
And so we changed the name. And then after that fund was invested and exited, my partner and I wanted to stay together as partners. And we went in a much different direction than we had expected.
Okay.
We thought we'd get a couple of deals done, raise a new fund, but we fell in love with the opportunities we saw in raising capital on a deal-by-deal basis. And that's the essence of what an independent sponsor is.
Yes.
Rather than having a fund of committed capital, which is what most private equity groups are, we find opportunities and then go to those groups to get funding for our deals. So each deal stands on its own. And as we'll get into in a little bit, there are all kinds of reasons that's become a very important part of the private equity community that supports the groups with committed capital.
I like the way you provided the contrast between the two, because there is a difference in that differentiation. It's not that necessarily one is better than the other, but one is more fitting for various circumstances. And you and I see a tremendous amount of business opportunities out there in the market. But even from our side of the table, on sell-side advisory, we know that there are just certain projects that are better aligned with independent sponsors, because there's capital needs to be solved, but sometimes there's a little bit more than that that needs to be solved in the organization. And there again, there's different thesis and different approaches that a private equity group would have versus an independent sponsor group. So with that said, can you tell us, as an independent sponsor, what do those buyouts look like for you? What are you looking for? What are you gravitating towards?
So as a group that doesn't have committed capital, there's all kinds of challenges that we've got to overcome.
Okay.
it's hard to be relevant if you don't have a fund backing you. It's also not the easiest thing to get a seller or an advisor like yourself to take the leap of faith that if you agree to support us and we sign an LOI that gives us exclusivity, that we're going to be able to get it funded. And we've overcome that issue and have a tremendous amount of credibility. We're proud and have always appreciated your support in that. But there are certain things where we're a uniquely good fit. And one of those areas, and you talked about the problem at the beginning.
Correct.
One of the biggest problems that backable executives who want to do a buyout have is who's going to trust them if they've never done a deal and they don't have the money.
Yeah.
Especially their employer, who knows how much they're getting paid and doesn't necessarily want them focused on how do I buy the company.
Yes.
They want those people focused on how do I increase the value of the company.
Okay.
And so that is a path that a lot of backable executives don't realize they can go down because of those credibility issues. What we know is that private equity groups want to invest in individuals who are backable. And what do I mean by that? Well, they've been success in they've had repeated success.
Right.
They've had C-level responsibility.
Yes.
And they have a vision for creating value.
Right.
Well, what we bring to the party is we fill in the gap that they've got. Okay, we have credibility in raising capital, and we have years of experience in getting deals done.
Yes.
So it's a uniquely complementary fit, and there's some benefits to that help them. One is we're not their boss. So if they're going to go try to do it themselves and talk to private equity, they're talking to people who are going to control the company. So dynamics
Typically,
are a lot different. Secondly, they don't have, that's a steep learning curve. And so the clock is ticking, and the chance of them getting it done before they lose exclusivity, is pretty high. So if we can team up together, we heighten the probability of getting the deal done, and then our process is oriented towards getting an LOI getting exclusivity before we bring in our funding partners. And that's always a challenge for guys like you as well, because you go, okay, well, how do I know you're going to be able to do that?
To deliver, yes.
And we have never signed an LOI and not found the capital we needed. It's just part of the reason that we have the credibility that we've got.
And that's refreshing.
But
and that's why we love working with you guys, right?
Which, like I said, I appreciate. The reason that hit rate is as high as it is because, one, the level of engagement from the funding partners is very high. First thing they ask me when I call, hey, I've got a deal for you, is, have you locked it up?
Yeah.
Okay. Yes. Versus, no, I'm competing with a bunch of people. But second, we don't want them to hear the story the same time we do. We want to take the time with your support to be able to put together a package that's compelling, highlights the risks and the mitigating factors, and that really is what's enhanced our hit rate.
Absolutely.
Because we're packaging it properly. Again, that all flows to the benefit of the team. Go ahead.
No, and I want to chime in on that because you're talking about there's always the numbers of the business, and then there you apply this narrative. And with your background and your history and your experience, I mean, I'm sure you have white papers on the investments that you've made, and you've done well on those. But the reality is, your narrative is going to be articulated differently than the seller or the target company themselves, right? Because they have an expectation. That's why they're going to market. And to your point, you can take a look at that company, and you're going to identify things in that business or opportunities in that business that perhaps they don't see. I mean, they will have their own agenda and their own list of priorities, but that does not always align with what capital partners are looking for. The experience you're talking about is you do know what capital partners, what they're looking for, and not every deal's for every capital partner. So the beauty of being an independent sponsor is you could pick and choose the right form of capital for that specific business at that particular moment in time of their growth cycle.
Okay, this is being recorded, right?
Yes.
Because I want to write that down and use it for myself because that was so well articulated. I really appreciate it. We're confusing. So it's always a pleasure to talk to somebody who gets it. There's another element of this too, which backable leaders don't, many of them, especially if they haven't done it, don't realize is that private equity deals all have debt.
Correct.
And debt adds what's called financial risk to the investment decision in addition to whatever business risk
That's right.
that business has. And the financial risk is now you've got debt service obligations you got to pay, and they don't care why you can't. Okay? If you can't,
that's exactly right.
now there's all kinds of consequences.
Exactly.
So for a backable executive to want to go down this path, they not only need to understand or be the leadership that somebody wants to back to create value, but they also need to understand that the investor, at least in private equity, is going to burden the company with some debt. And the reason for that is it elevates the rates of return.
Precisely.
And so now it comes down to what's a prudent level of debt, understanding business risk versus financial risk. But the more important point is the better a team understands that that's part of the equation, the more appealing they are going to be to the investor, because from the investor's point of view, wow, they're not just backable because of their business acumen. They also understand what we care about, and that leads the investor to feel a lot safer. And want to embrace that team as a partner. One other thing I want to comment on is that with 30 years of experience doing these deals, we've got a very good playbook for best practices. And so many businesses, as they grow, have growing pains. And one of the most important things is managing, or opportunities, is if you can take an entrepreneurial, founder-led company and over time, add more services and capabilities of, having an audit versus compiled financials, or having a CFO versus a controller. But there's a lot of things that can enhance value the bigger the company is, and the reason is the lower the EBITDA or the profitability, and I mean dollars, and I'd say $5 million or below. That's a higher risk company than a company that's got 10 million or more.
I know this, but for the listeners, why?
Because there's all kinds of reasons, but back to entrepreneurial leadership, professional management, advisors,
or chart of perhaps of the organization,
right? So advisors. So having consultants or accounting firms or the like versus the barber or YPO or various people. Dependency on one person. A smaller company is more vulnerable if you lose somebody that is the key to the business. As you get larger and you strengthen the management team, there's less dependency. The point being, though, that if you can increase EBITDA from below 5 million, let's say, or double it, let's just say, not necessarily, then you're going to get a higher multiple when you exit, because the risk is lower for the same business model.
The perceived risk by the investment community is lower because you've achieved and reached this critical mass. But that critical mass is not just being big, but typically what comes along with having that critical mass is, I was saying, you have the org chart of the CEO, the CFO, you have the controls in place. Everyone is focused on the same vision and purpose, right, within the organization. But that is, without that critical mass, it's almost, they haven't proven themselves,
so let
right?
me give you a couple of other examples that become important in this
Okay.
equation. The
Okay.
first is oftentimes, and where do we come in? When I would say at a transitional event that requires liquidity
Okay.
or generating cash.
Yes.
Now, most people think of this as when the owner is ready to retire and sell the business.
Correct.
And there are a lot of situations where the controlling shareholder isn't the one who's actively running the company and creating value.
100%. I mean, I'll tell you a quick case study that we're working on. We're selling a company, privately held. It's being sold to a strategic public company. But the owner, to your point, the owner doesn't even know he owns a company because unfortunately his mental health is deteriorated and he has Alzheimer's. So we're working on this case and we're working with the family and the trustees and the attorney, but we are all going to exit our companies as entrepreneurs at some point in some way. We just don't always know how. I mean,
Or have control over when.
have control over when. That's exactly it.
No, and so one of the things we do when we're fortunate enough to meet a backable team and we're under consideration, what are you doing that you really isn't helping the value?
Okay.
And what would you like to do that you haven't been able to because either the owner doesn't embrace the direction that you want to go in, but more common, the owner doesn't want to add risk to the company's ability to generate cash flow. Add-on acquisitions usually mean you got to bring in outside capital to make that add-on acquisition, and now you're merging cultures, and there's all kinds of tricky elements. Another reason there for a transitional liquidity event is one partner wants to buy out another.
Yes.
And they don't have the money to do it. Yet a third is owner wants to keep running the business, would like to take it to the next level, doesn't want to put any more capital at risk, but also all their net worth is tied up in the value of the business. So they can do what's called a seller recap, where they effectively sell controlling ownership of the business. They still retain a meaningful amount. They still run the company, but now they've been able to take some chips off the table. But in addition, they've got a financial partner who's willing to write checks to take the company to the next level.
That's right.
So there's a lot of different circumstances that would lead to this type of partnership.
Okay. About roughly, how many businesses or opportunities do you look at in a year?
I would say seriously.
I would say let's classify it generally, seriously, and then closings.
Okay, this funnel goes narrow really quick.
Yes.
200.
Okay.
Seriously, 20.
Okay.
And 1 to 2.
1 to 2. Okay. And I knew that answer. I just wanted everyone to hear it because this really steps into what I identify as some of these growing pains, right? And so you see at least a couple hundred opportunities a year. You get really serious about 10% of those companies, 20 of them, and you close on 1 to 2 of them, right? So you and I, we see more deals not happen than they do happen, right? What would you share with those listening, founders, entrepreneurs, and CEOs? What are your experiences and insight for them that are facing these challenges as they're looking to pursue this growth and align themselves with a capital partner? What do you see those growing pains from all these businesses that you've seen?
Well, And as an independent sponsor, we are on what I'll call the micro end of the middle market.
Okay.
So most of our transactions are in the $10 to $30 million corridor.
Okay.
Part of the reason is
EBITDA or
transaction value.
Transaction value.
Now,
Okay.
we just closed a deal. It's It's larger than that. But
Yes.
The reason for that is that the independent sponsors don't always get a seat at the table in the larger sale processes, because why would you why would you give us a seat at the table when there are thousands of groups that have committed capital?
Yes.
Now, what that means is that we're looking at deals that have a little more hair on them. They require a soft touch.
Yeah.
We have to really dig in. Remember I talked about the packaging, where we go in and we
the narrative.
want to get the exclusivity before
That's
we
right.
reach out to capital partners. Well, part of being able to get deals done that are in this micro end is really digging in and understanding the story. And part of the reason we get that opportunity is there aren't as many people who are willing to do that.
Yeah.
So one of the most important things a seller should be thinking about is grooming their company for sale. Because we talk about businesses, the challenge of deals closing. Well, first of all, there's one thing that a lot of owners, there are a lot of factors that come, or there's only a couple of factors that come into valuing. When somebody's looking at a business, if they're going to invest, they want to know that when they sell it after they bought it, they're going to make more money. Okay? And the keys to that are that the new owner was able to increase the cash flow and protect against the risk that something is going to go wrong. And the smaller companies we talked about before have more risk.
Okay.
There are a lot of external factors that affect cash flow and affect risk. But there's one factor that the owner has total control over.
Okay.
Quality of financial information.
Absolutely.
And that information is the window that the investor looks through to decide, do I like it? How much am I going to pay? And for those owners who have never gotten reviewed financial statements, let alone audited financial statements, and QuickBooks, okay, the worst. No. The worst is tax returns.
Yes.
Okay, here's 3 years of my tax returns.
Yes.
Make me an offer.
Yeah, make me an offer.
Okay. But then with QuickBooks, or what are called compiled statements, there isn't a third party verifying this. And one other very important point for those of you who really want to make sure you're heightening the likelihood, not only getting it closed, but maximizing your value, is those of us who are institutional investors, the numbers need to be in accordance with what's called GAAP, generally accepted accounting principles. And if you'll recall, I mentioned that private equity deals have debt.
Yes.
Okay, well, the debt part of the equation is going to be based on a multiple of cash flow, okay? And they're only going to look at cash flow in accordance with GAAP.
That's right.
So you are blocking out a huge part of the market if you haven't invested in financial statements that properly present the information.
Yeah.
And I see that so common.
We do as well. And in our process at Meritage Partners, what we do is we spend a lot of time looking at that initially, because if they're not market ready, that's okay, right? Because as you and I both know, you could speak to this. If we were a firm that were to take a client to market without being prepared, we're quickly going to find out we're not prepared, and then we're going to step back.
The other thing
right?
is you may, because you're always going to say, here's what I think is a reasonable valuation for your company.
Correct.
But if that reasonable valuation is based on numbers that are likely to they haven't been independently verified, not only is there a risk of deal not getting done, but Brian, you can hurt your own reputation.
Absolutely.
Because a seller has a certain dollar amount
That's right.
in their head.
That's
And
right.
it was a self-inflicted wound
Yes.
that led to
Yes.
the lower valuation.
So that's the pain. The pain is unprepared financial statements. We call it, they need financial house cleaning or financial housekeeping before the review, before the audit, or before the quality of earnings, because bad data in is going to be bad data out.
Let me mention one other thing that's awfully important.
Please.
And this can get a little pricey, but by the way, this does not serve my interests. Okay, so I want to qualify this.
I understand, but I know what you're going to say, and what you're going to say is there's ROI tied to it. So let's not forget to mention that.
Well, that's another point.
Yes.
But the key thing I was going to say is financial buyers do what's called a quality of earnings due diligence. And all that means is they go in, they bring in outside accountants, and whether the numbers are in accordance with GAAP or not, they come back to you with a GAAP adjusted EBITDA number, okay?
Yes.
You do not want that first QV to be the one that the buyer is doing, okay? You don't want them telling you
That's right.
that, well, your numbers aren't nearly as good as you thought. I thought I could pay X, but not only am I not willing to pay as much, but boy, what other financial surprises might be there?
Yes.
If you are serious about selling, one of the best things you can do is do what's called a seller quality of earnings.
Yes.
So you're now telling me, here are the numbers, they've been vetted, and let me tell you why that's important. If I see financials that are compiled, QuickBooks, you don't have a third party,
Yes.
I'm going to knock down that multiple a couple of turns.
Yes.
Okay. Why? Because there's a risk that the numbers aren't going to come through
That's right.
as they've been presented.
You could anticipate that. Safely.
Back to the window that I'm looking at versus you've got reviewed financial statements. They don't need to be audited. You've got a nice financial package. It's got what called key performance indicators, KPIs. My predisposition is going to be, well, this is pretty clean before I even look inside.
Yeah.
And that impression affects materially
Absolutely.
the value that somebody is going to offer.
Absolutely. The goodwill aspect and look at that business, right? Because, to your point, I mean, QuickBooks is not perfect, right? And the data going in is not perfect.
Let me give you a real quick QuickBooks example.
Okay. Yeah.
So
we love case studies.
So no, this is a good one. So terrific company.
Okay.
Got introduced to the owner by another person we know.
Okay.
Went down, met with him, and it really felt good about each other. And he has a great business.
Okay.
So he goes, okay, I said, send me your financial information. He wanted me to make an offer after he sent me the financial information. And by the way, you don't just make an offer after somebody. But putting that aside, it was on QuickBooks. And QuickBooks doesn't show a year-over-year comparison. Each year is on its own. Okay, so I had 3 years of just financial statements.
Data. Yeah.
So I took that data and I put it into a spreadsheet, and I then called him. I said, your accounting screwed up. We need to talk.
Yeah.
Okay, so I go down there and goes, what do you mean? I said, well, your inventory balance 3 years in a row is exactly the same. And he goes, what do you think? I'm cooking the books? Like, you got really defensive.
Yeah, I got defensive, yeah.
And I said, no, but I guarantee you something's not right. And because the inventory is exactly the same each year, I can't trust your gross profit.
Yes. Because you don't, yes.
And
is it LIFO? Is it FIFO? I mean, we could go into all of that, but that is now in question.
And I said, what you don't want to do, and now I'm repeating myself, is you don't want me to be the guy who sends in my team, looks at that, and then uses that to my advantage because now you're vulnerable.
Yeah.
You really need to send somebody in before we talk any further, whether it's with me or somebody else.
Yeah.
He did that.
Okay.
The numbers were actually pretty close, and I won't go into them accounting. No,
okay.
first.
Yeah. Okay.
No, I mean, you always expect things to go in the other direction. But my
do.
point being, we end up signing an LOI with that company.
Fantastic.
And through that process, I gained trust
Yes.
with him, and he gained trust
Yes.
with me. So my point being, don't leave yourself open to weakness
Yeah.
by just, plopping something in front of somebody. You're going to regret it.
Yeah, we tell clients this too, in the education process, a portion of our process, because they need to know what they're getting into in these conversations and dealings. And what we typically help them understand, and what we want them to understand, is that you and I, if we're negotiating on a deal, which we have, it's not as we're bringing a number, you're bringing a number, and we say, okay, let's meet in the middle. This is not the way negotiation occurs, right? Negotiation occurs by way of data and clarity, right? In third-party prepared financial statements certainly give you the optics and the perspective that you need to know that that information is going to carry not only today in this introductory portion of the conversation and process, but through due diligence and the sets of eyes that will be on that data from your lenders, your LPs, your partners, and everyone involved. And even yourself have to protect your reputation, because if you're bringing deal after deal after deal based on QuickBooks data, you could spend a lifetime there doing nothing, right? And so this is why it's important, and we say this to our clients all the time, this is why it's important to spend that time, because there's no way we could collapse time while we're in the middle of negotiations. Collapsing time comes prior to going to market and preparing in that way, because the more data that we have, right, the more favorable you're going to look at that opportunity. And specifically the financials being prepared by, let's say, a Salary Q of E is going to ease anxieties and give you a lower perception of risk of what's there and what could happen through this process. Right?
Is it okay if I compliment you?
We could spend another hour doing that.
Okay. I'll try and keep it a little bit shorter.
Okay.
But one thing I do
Bruce.
want to say, Brian, is that you bring a value to your clients, not just because of your experience, but I've always felt like I'm your client in any process I've been in with you, even though I know you represent the other side.
Yeah,
and that
makes sense.
helps me feel safe. It also makes me feel safe enough to be more open about what I'm thinking, what I want, what I need. And that is a rarity, but it makes me want to look at more of your deals, as well as, it's me and my partner. So we have a limited bandwidth in terms of what we can and can't go into.
Yeah.
So for those of you, who are thinking about this, I just want to tell you, you'd be in good hands with Brian.
I appreciate that, Bruce, because we at the end of the day, I try to find the common denominator of what we do, and what we do at its core is we're part of the core is managing expectations, and those expectations you come to the table with a set of expectations in terms of investments that you want to make. Our clients come to the table with a set of expectations in terms of liquidity or path or focus, right? And we have to work to manage those, right? And sometimes those expectations are not realistic, and we're not going to win in a combative, abrasive conversation. We're going to win together by having that discussion and educating the client on what's going to happen and when. And I appreciate you taking notice of that, because really that's what has contributed to our success as a firm, but in the reputation that we have in the marketplace, but also it helps our clients. Because this is, as you know, this is not a process for everyone, right? And the better you are equipped for this adventure and this journey, the more rewarding and fulfilling it'll be throughout, and even post-closing. And so that's what we want. That's when you look at our values and our focus with our clients, that's what we want to bring to the market. And we work carefully to do that, because if not, you would have not said what you just said. You would
No. I really wanted to share that because I very much appreciate
Thank
your
you, Bruce.
approach as a buyer.
Yeah. I really appreciate that. Thank you so much. And so, but we talked about the pains of not having the right financial statements prepared, and specifically third-party reviewed or QOVs. The possibility and the cure of that is work with your advisors.
There's a bigger point.
Okay, please.
Don't be penny wise and pound foolish when it comes to this.
Okay.
We have a thing we call the Value Creation Roadmap, and
Okay.
I've never shared that
Yeah.
with you, but
Love to see it.
it's
Yeah.
a tool that we developed. It's got 36 valuation factors, and
Okay.
it's a combination of cash flow
Okay.
versus risk factors. And quality of financial information falls into the risk factor.
Yes.
And out of 36, as I said before, there's only one that the owner has total control of, is quality of financial information, which you could also extend to other aspects of the business.
You could.
But the point being, doesn't matter how the economy is, doesn't matter how much competition you've got, okay, you either are willing to spend that to, improve both the quality and the appearance of your financial picture. But there are several other things that, and by the way, these risks differ, or these valuation factors differ if it's a financial buyer versus strategic.
Agreed.
So for example, one of the biggest risks that private equity groups or one of the biggest issues that private equity groups shy away from is what's called customer concentration.
Yes.
Okay? And the reason goes back to that financial risk. You can't afford to have all of your eggs in a couple of baskets where if you lose one of them, all of a sudden you can't pay your debt. Okay, so financial buyer, oftentimes will be a threshold issue, not a valuation issue, but they've got not too much risk. A strategic buyer, that may be the only reason they're interested. Why? Because they've never been able to get their foot in the door at Walmart, and this company supplies Walmart.
Yeah.
Now buy the company, now my foot is in the door. Growth prospects, okay? That's a cash flow oriented factor. Okay, what's the likelihood after we buy the company we can continue to grow it, generate more cash?
That's right.
Growth achievability is a risk factor. Okay, how familiar are we with the direction that we're going in? Are we going to do something we haven't done before, or have we done it before? How much are we going to have to invest to go in that direction? Okay, so in terms of if somebody's going to factor that into the valuation, the more it lines up with what the company and the management team is skilled to pull off, and the less it costs, so on, the more that's going to translate into a higher multiple. So those are just a couple of examples.
In the coming weeks, I'd love to look at how you approach that and using your tool, because it sounds like it's a proprietary tool that you developed, and it really helps even us, because we're always looking through your lenses, and how is this going to be perceived in terms of risk, primarily risk, right? Because the burden of proof, you could agree with me that the burden of proof is on the south side of the table, right? You cannot come in and generate reports for the purposes of what we're talking about. This has to be produced and managed by the sell side, and that means the client, our client, and it means also it means with the process, and so. But I would love to spend that time with you.
We'll do that. One of the interesting things, just conceptually, is it's got a report card. But you either put down strength or weakness.
Okay.
And if it's a W, it's a point of valuation vulnerability. And the more W's there are, the lower the multiple is likely to be, because the buyer can look at these things and say, well, I'd pay a little more. And as an owner, if you can identify what the W's are, you just need to neutralize it. It doesn't have to be a strength, but you want to take out of the equation things that people can point to. One other helpful hint. If you do have customer concentration, you don't need to totally bring it down to really small percentage.
Yeah.
But you've got to demonstrate that you can turn the aircraft carrier. Okay, so as long as you can do a couple of years of showing that's going down, at least the trend line will help keep people at the table and not penalize you on the valuation.
Yeah, you're exactly right, because that valuation multiple, right? There's always a spectrum in every industry, and the question is always, where does that client land, or where does that opportunity land? So I'd love to take a look at that. I appreciate you giving that advice in that direction and spending the time with us here on the show today. Bruce, I wish you all the success in the world.
Well, let's do something together.
Yeah, and we will. And congratulations on the recent closing. I know we have a couple opportunities that we keep a pulse on together, and I'm excited to look at those with you and continue the relationship. But love to have you back on and whenever you like, and maybe we talk about that scorecard.
It would be a very interesting session.
I think so.
Well, thank you.
Thank you, Bruce.
Okay, take care.
Until then, we appreciate you joining the Private Capital Mastery podcast and community. We hope you were educated, at least provoked with some of the thoughts and ideas that were demonstrated and illustrated here today. We invite you back next week, where we continue to open up our playbook and unpack more details about the private capital markets. I'm your host, Brian Franco, and have a wonderful day.